2 मिनट ऊपर
Hello, everyone. Welcome to this session of webinars, the pre-COP webinars, which has been arranged by Spectorico. Today, the topic that we are going to discuss is related to the International Financial Reporting Standards S1 and S2 of sustainability. As you know, the International Accounting Standards Board made another board, which is International Sustainability Standards Board. And the first two standards that have been issued are S1 and S2. S1 is for the general requirements for the disclosure of sustainability related financial information, and S2 is related to the climate related disclosures. Today, in this particular session, we are going to talk about the implementation of these two standards in general, also across different countries, and very specifically for the Saudi Arabia also. I am your moderator for the session, Alina Karim. I am also a sustainability professional and currently the lead trainer and consultant at Shaw Trainings and Consultancy. And our expert and the main speaker for the session is Sajid Aslam, who is going to take you through the presentation and have a Q&A session at the end also. Sajid is a chartered accountant and a sustainability reporting professional, and he's currently the founder and partner at Spectorico. So I will hand over the mic to Sajid for the introduction of the today's topic and how the implementation of S2 and S1 and S2 is going to be in Saudi Arabia. The today's session is going to be very focused on the how part. So how everything is going to be implemented, what are the current regulatory requirements, and what can you do to be up to date with the regulatory requirements as well as the opportunities that come with sustainability reporting. So I would welcome Sajid to the session.
Thank you, Elena. Thank you very much. And I think it's a continuity of Spectrico Transition Dialogue, which we started a couple of weeks back as a preparation for the pre-COP. We already conducted on a green financial instrument. We also talked about the SEC US climate disclosure. And going forward, today we are talking about the IFRS S1 and S2, specifically KSA as a scenario. And going forward, we will have some session on real estate and nature-based solutions. So this series actually helping us and definitely a lot of people around us to understand what to expect from COP29, as well as what to really advocate during the COP29 and post COP29 as a part of the adoption of different frameworks as well as for the reporting standards. So I'll share a few slides here, Alina, first, and then we will get to the more question and answer session.
Sure.
So we will try to keep it as interactive as possible. So first, a little bit introduction around Spectrico. Spectrico is a global technology advisory and implementation company, which is based out of US. So we are headquartered from US, and we have got a presence in Europe, Middle East, Asia Pac at the moment. And we provide technology which helps simplify the overall transition, regardless of the regulations, regardless of the standard you would like to adopt. So it's practically technology and regulation agnostic, and it comply with all the different regulations which are available around the world. So it's designed in a way that technology and a managed service alongside with the technology help a quick transition and quick adoption of sustainability journey in real estate and financial services specifically. So let's first understand what are the key drivers for sustainability reporting in Saudi. Why people should or organizations should care about the sustainability. The first thing I must say that the Vision 2030, which come across a very compelling vision, and the progress we are seeing and the decisions which we are seeing around the Vision 2030 implementation and the funding which is going on, that's marvelous. There are very few countries or regions who are really implementing the vision at that pace where the Saudi is moving right now. And few goals of the Vision 2030 are directly related how the organization really track their sustainability journey and provide that visibility to investor and the general public to really bring that reputation of KSA as a sustainable country for living and business both. Second part, if you look at the implementation side, there is an investor who are who are basically right now requiring organizations to really share how they are managing their climate risk and opportunities, both side of it, and what kind of investment they will be making and what kind of projects they are undertaking. And similar demand is coming from the consumer side as well. So consumer are also asking for the certain action on a climate side, that how the organization is impacting the climate and how the climate change is impacting the organization itself. So the banks and the real estate, why we talk about that, there's a certain surveys and the research which is bringing out these two sector as a primary sector. If they go as an early adopter, so that will really encourage the rest of the ecosystem to really adopt the sustainability reporting, but most importantly, the sustainability journey. So if you look at the PIF, so the under Vision 2030 PIF is a one of a major organization as a funding arm towards that Vision 2030, who has a significant focus on sustainability itself. So whether investment is going on a real estate or infrastructure or a financial institution or a innovative technologies, at the same time there is always a certain criteria which is associated how this particular business organization technology is going to positively or negatively impact the climate, or how the climate change can impact that specific business. So there is a certain risk assessment which is already embedded within the PIF funding requirement. If you look at the Saudi exchange, the Dawul side of it, so we are talking about, there's a conversation right now. There are few things which are still under implementation. There are few areas where there's a certain conversation which is going on. There are committees in place, and there are certain guidelines which are expected to be there, if not end of this year, early next year. And ESG indexes, listing requirement, and ESG frameworks are the top of the list in terms of conversation which we are hearing from Tadawul. Similarly, the central bank, they are also following the sustainable finance roadmap. They are also working with the other central bank that how the green finance initiatives or guidelines are already there. There are few regulatory framework which are implemented or discussed, or the guidelines which are in the process right now, and all are going to be integrated soon. And when we say soon, we are talking about couple of months or maximum a quarter, where system integration, regulatory framework, and the adoption requirement from the central bank will be out there in Saudi. Again, if you look at the NDC, the nationally determined contribution, one of a commitment of KSA with the United Nations. So that's also highlight the sustainability focus, and also talking about the green building as a one of a key initiative, and also talking about the financial commitment and the funding models which will be deployed in KSA to really bring out the sustainable solution, like carbon capture and usage and storage is one of a key area which is already implemented as a part of the NDC commitment in the energy sector. But the similar items or similar initiatives we are seeing in a financial sector as well as from a building sector. Corporate law, so that's another enforcement agency within the country which is talking about the transparency and accountability, compliance and reporting, and harmonization with IFRS standards. So this conversation and debate is already there. IFRS S1 and S2 adoption dialogues are already planned for Q1 2025. So these are the key areas where regulators, whether it's a corporate regulator or a banking regulators, or the listing regulator like the stock exchanges, they have already started their conversation how the sustainability reporting and specifically adoption of IFRS S1 and S2 is going to play a role going forward for the country and the organization and the way the business really manage their climate risk and report their climate risk. And then most interestingly, there is a demand coming out from the investor side on a sustainability finance side, climate risk side, the social side, the environment side, that how the organizations are going to manage or how they are managing today. So both of these scenarios, in both these scenarios, that means the organization today have to start thinking about early adoption or start preparing the organization and the operations in a way that when these regulations are mandated and that standards are adopted, so they are ready, they are prepared. So we have to anticipate what's coming in the business side and really prepare the organization in terms of talent, technology, infrastructure, and operations, that at that stage we should not end up as a non-compliant organization, or we are unable to really produce those data and report which the compliance will require at that. So again, if we go with the key area, so international investor scrutiny is one of a key area. The key criteria for global investors, sustainability report and a non-financial disclosures are becoming one of a key area. International capital, if KSA want to attract the international capital, again, it's important that we deploy that kind of initiative where people can understand the ESG risks and opportunity for that specific organization, and also for the benchmarking in terms of the competitiveness, how the organizations are doing compared to other international opportunities out there. So there is a certain pressure which is coming from a regulator, but again, the main pressure coming from the investor who really want to understand the climate risk and the ESG risks and opportunity, and the understanding of the governance processes organization has deployed to really manage that kind of risk and opportunity. So if you look at the overall global picture as we speak today, so there are 28 regulations which were enacted between 2007 and 2020, which is ESG focused regulations. And if you look at the 21 onward, going forward, we are seeing 173 regulations which are enacted or pending enactment right now. And out of these 201 regulations, 30 regulations are coming from Middle East and Africa. So right now, the highest number of regulation is in Asia Pacific, which are still under implementation. In Europe, there is a 53 regulation which are enacted, most of them. Americas is also following the 50 different regulations, and Middle East is working on 30 as we speak today. So all these regulations have got a one common requirement that is called compliance and reporting. So it's not only we are not talking about another 600 regulations which are more in terms of how the operations or how the EPA, Environment Protection agencies are implementing those ones. We are talking about those regulations which require an organization to really compile the data and report on a component of environment, social, or governance. Another area why it's important to bring a standardization on ESG reporting is the overall rating. If we see, and we did a one analysis in Spectrico, there's a lot of ESG rating which is done in US and Europe around the Middle Eastern company. Those ratings are not very accurate, and they are not accurate because there is not enough comparable data available. So based on their ESG framework, they identify it as a one of a risk. So we can see a controversy, even a one agency versus other agency, we see certain controversies in the ratings as well. But if we look at the overall rating, where based on our understanding and the recent visit to KSA and discussions with the large organization, which most of them are part of this ESG rating one way or other, they have progressed in a very different and advanced level. But that data is not available to most of the distribution rating ESG rating companies to evaluate and assign the right kind of rating. So that's also one of a reputational thing which can be fixed very easily with the Middle Eastern companies if they start early adoption and start reporting the sustainability data on any global standard. And that will bring a very good reputation specifically for KSA, who is very aggressive and who have got a lot of initiative around sustainability. So let's talk about IFRS S1 and S2 specifically, look at their structure and see what we can do today, how we can go for early adoption, and what could be the potential challenges there. So IFRS S1, S2, these are the standard, and luckily IFRS has consolidated different initiative which was out there, which include the value reporting, which include the integrated reporting, which also include the TCFD, and then everything and SASB as a one of our organization. So everything is consolidated right now under the IFRS, and IFRS using all those existing initiatives have started devising the different standards. And the two standards which are already released are called S1 and S2. So IFRS S1 basically help establishing the overall reporting framework and the governance structure around the disclosure, where S2 significantly discuss or handle the climate related disclosure, providing a clear guideline for emission reporting at this stage and risk assessment and opportunity identification. So if we categorize as a journal, so we see the governance processes as a one of a key area to be reported. The value chain risk, like not only the organization itself, but the upstream and the downstream partnership and the relationship which exists as a supplier and customer, what kind of risks are actually out there. And then the materiality assessment. The IFRS doesn't believe that organization should report and everything under the sun. They have already defined the criteria for materiality. So every organization has to assess what is material for them or their stakeholder, which requires a certain reporting. Carbon reduction plans or a transition plans are the important plans which need to be disclosed. GHG or a carbon emission disclosure, which include the calculation, measurement, tracking for scope one, that means what they are directly emitting. Scope two, that means what they are emitting through consuming the energy from the third party. And scope three, which means the entire supply chain, integrating the emission reporting from the supply chain side. So most of the countries, when they start adopting from scope one and two, and scope three always have a longer period for adoption or have a relaxed approach, but depend on the maturity of that jurisdiction, depend on the urgency of that country in terms of scope 3. But this is one way or other, down the line, this scope 3 emission is going to be there. So that's why the value chain risks are important to understand and evaluate as per the IFRS. So under S1, what we need to report is what is the oversight, how the governance structures are designed to identify the climate risk, how the board is working, how that risk is identified and reported at a board level. What is the strategy to really address that risk and opportunity or seize that opportunity in a short term, medium, and long term basis? How the risks are managed, mitigated, accepted, avoided. So it could be a insurance as a one of a key area if we are transferring the risk if possible. And what is are the key metrics and the targets? That means what is the material topics which organization should look at, and there is a complete process of materiality assessment. And what are the key targets? How much they want to reduce in terms of the carbon emission, or how they want to really move on in terms of their social KPIs at the same time. Where when we look at the S2, so S2 specifically talk about the physical risk, the transition risk, uh, climate opportunity, which how the climate opportunities are being identified. So there are opportunities as well. So it's not only about the risk, and the scenario analysis. If the organization keep working the way they are working, and the transition plan they are implementing, how it will look like for the 1.5 degree scenario or a 2 degree scenario. And these are the scenario means how it will help reduce the emission and the global warming in general, right? So from there, so these are the key areas. So let's look at the key areas once again. So we have got an opportunity to really understand the governance strategy, risk management, and the key metrics and the targets. So that's S1. What are the disclosure requirements are? And the second part, which is very much climate related risk, we are talking about the physical risk, that how the physical risk can impact like the floods or anything, or higher sea level, how it can impact the erosion of the foundation. Transition risk, basically, if the change in the technology and the laws or the market, if the habits will change based off the climate change, so how that is going to be addressed at the same time. Climate opportunity, what are the kind of new products organization is working on or adopting? And the scenario analysis is the one of a key area where we can really evaluate the physical risk, which can help business assess the impact and inform the strategic responses to the respective stakeholders. So these are the key areas from a disclosure perspective. So it's easy if we are talking high level. Let's look at what are the key challenges so far the world has seen. The most biggest challenge is to understand how to collect data, which is a non-financial information, and how to interpret that, and how to manage it, and how to validate, and how the consistent calculations can be available to the key stakeholders to compare the one year versus other, or compare it with the one industry to other. And then how the limited or reasonable assurance can be implemented on these kind of reports, including the audit trails. So if I take an example, when the IFRS initially introduced, let's say we are talking early 2000, so we have gone through the similar journey. It took some time to understand what the IFRS requirements are, how the data need to be captured, how the estimates need to be established, how the assumptions need to be reported, and how the auditor has to go through making sure or providing a reasonable assurance that these estimates, calculation, and the data which is presented in a financial statement in a very specific form in terms of the P&L balance sheet or the notes. So how these need to be presented. So that structure was prescribed by the IFRS at that time, and the world has gone through that journey once. Similarly, we are going through that journey now, but it's non-financial data which is becoming more under discussion, and specifically focused on the ESG or a climate risk for that matter. Just a quick example around the real estate. What happened at the real estate? So, any organization which is a real estate focus and managing multiple assets, so the first requirement or ideal scenario is that we should be managing that asset level metrics. So for every asset, for every real estate asset, we should be looking at the energy, water, waste, operational efficiency, indoor air quality, and there are few elements which also are embedded in terms of the materials to assess the life cycle carbon assessment. So there is a term used in the real estate, the carbon life cycle assessment. So from the construction to the end of life, how that particular physical asset is going to contribute or get impacted with the climate change. Then portfolio level factors, that means that the geographical risk, the property diversity, the tenant engagement to enhance the strategic oversight around it. So how we are managing the entire portfolio, set the smart targets which are more achievable from emission reduction, green certification, renewable energy integration. And sometimes we have to go and talk once we are going through these kind of transition plans. We have to take an ecosystem approach, and we have to engage the energy distribution companies as well as some other ecosystem players like the space or operational efficiency in terms of the services which are embedded within the property. And then I'm sure, like everybody anticipate, there will be certain challenges in terms of the data, and that's why the early adoption is always encouraged, that you have enough time to look at the data sources and the validation of that data. So from an implementation of emission accounting or a carbon accounting, the term which is now generically used, the carbon life cycle assessment is a very is a specific assessment which I always encourage. If you are in a real estate business, spend some time. It takes couple of months, and you can really assess that what is the life cycle assessment, and that helps you to create a transition plan to manage that and compare that what actually was planned and how we are doing against that plan. So scope 1 and scope 2, like we earlier discussed, is the purchased electricity and the direct emission which is coming from the property with the use of different sources or resources. Emission 2, 3 is all about the third party tenant operation, commuting, waste, as well as from the supply chain at the stage of construction. And then in a building site, it's important to integrate a building management system. And if you are one of a real estate company which is managing multiple real estate and a multiple type of real estate, whether it's offices, hotels, if you are in a hospitality business, shopping malls, residential properties, or residential apartments. So there is a building management system which can help you to really keep a track and keep generating that information, which will be required or which will be encouraged at an entity level to report how they are doing on a sustainability journey and how each property is doing around the key benchmark. Similarly, if you look at the banking side, and that's in Europe, they have started with that. SFDR is one of a key regulation. When it came up with a proper definition, what does green mean? There are a lot of financial instruments which were considered green before that regulation were no more green. And now, what is the green as a label mean for a financial instrument or for any product? That has got a very specific definition, which means that not everything can be considered green unless until it goes through a proper definition. In banking sector, the second challenge is that the emission coming from the banking operation is way less. The finance emission are 700 times higher than what the bank emit as during their operation. So that means the banking operation versus finance emission, that is something where the regulators and the central banks are coming and they are asking the banks and the financial institutions to create a certain visibility in terms of how their portfolio look like. So where they have provided loan or debt, so how those organizations are doing in terms of their environment or social metrics as a bare minimum. And for that, IFC has also introduced the ESRM as one of a key framework. It's a environment and social risk management framework, which a lot of countries or jurisdictions are adopting as a tool, and a lot of central banks are also encouraging adoption of ESRM as a part of their risk assessment while they are making decision for financing. But from a reporting perspective, it still comes down to IFRS S1 S2 or any other reporting standard which is applicable in that jurisdiction. So financial institutions are going to be the primary focus of the regulator to start with, because that impacts the entire ecosystem. When they will start asking questions before providing the financing or access to capital, when these kind of questions start coming in, the organization have to put their house in order. And to put their house in order, the only way they can do it by adopting a one international standard to make sure they are collecting enough data for reporting, not only for the external statutory reporting, but also the data which will be required by the bank to ensure that the organization have got environment and social risk management tools implemented there. For the finance emission, there is already certain standards, which is called the GHG protocol, is one of a key calculation method where the third party or a finance emission can be calculated. In USA specifically, they have introduced an additional standard, which is a derivation of GHG specifically designed for the finance emission. So in case of GHG protocol, there are five key components which are considered. In case of PCAP, there are five additional components on top of the GHG protocol. They are considered while calculating the finance emission. Calculation of finance emission is important to really understand how these organizations, the financial institutions, are contributing or in terms of the climate change actions across the globe. So what is their role? So how they are evaluating that risk, not only for themselves but also for their investor at the same time. If they are putting money to in the assets or to the businesses which are themselves are exposed to the climate risk, whether physical or provision, that means the risk of that particular institution is going to be considered very, very high. Benefit of adopting IFRS, and particularly the people who are going for the early adoption. So it bring out the early or enhanced risk management. It help improve the decision making, that how you can incorporate the sustainability focus across the different operations. The reporting is a tool to really report something which you are doing at your core business. So what are your business goal in terms of the sales growth, access to capital, retaining customer, retaining talent, how you are going to incorporate your sustainability narrative across all those key goals and align your goals and sustainability focus at the same time, so you can have a better ROI, or you can have a better focus or enhanced delivery of key components of sustainability. At the same time, it's also helped investor to understand the climate risk management, governance, oversight tools and data, and it helps them to make a decision. And most of the investors who are more comfortable with the climate risk management tools for one organization, they are willing to provide a certain premium in the valuation as well. And we have seen the instances where the central bank has came back with the reduction of the interest rate or the profit margin to reduce the cost of capital in journals. And then definitely it's while you are managing the risk well from a climate side, so it's ensure the long-term sustainable growth, which is also part of the Vision 2030. Uh, Definitely the biggest challenge which we see, and we have seen that for every change management, is the training, the talent, the people, the infrastructure, the technology, the data which will be required. And I think the best investment right now, any organization who is starting their sustainability journey or who have already started their sustainability journey, is either train their own team or use the external support which can help them to really enhance or increase their speed or a pace of adoption, and that's an important element. So the people will matter a lot, how you are really developing internal talent or how you are using the talent available outside, like in form of a managed service or in terms of the outsourcing. So these are the key decisions which organization need to take. But for sustainability journey and the reporting, it takes a qualified, properly trained people, whether on an engineering side or a finance side or sustainability professional themselves. Uh, Implementation challenges, and that's like any other businesses or any other initiative. We encourage that we take a phased approach and the data automation, because data is going to be the key here. And then from a strategic planning and expert consultation at initial stage, while you are doing your strategy formulation, or you are creating a framework or setting the boundaries or working on a materiality assessment, this is the time where you should consult the right kind of talent to ensure that your long-term journey is already has evaluated the different scenario and options which are available. And the governance, compliance, and monitoring is definitely a one area. Unless until there is a proper oversight, nothing get implemented in a right way. Stakeholder engagement, again, it's an important component of sustainability journey, and IFRS specifically stress on that and also ask for a certain reporting in a certain areas, that how you have engaged the stakeholder in terms of doing the materiality assessment. If you look at ESRS or a European one, there is a very specific requirement in terms of stakeholder engagement for double materiality assessment. IFRS doesn't go to that level, but they still encourage the communication of plans and early engagement of the stakeholder to understand whatever you are going to report as a material item, it's all really material for the stakeholder. Monitoring evaluation, that's a definite process if you are going on a project and a transition. So there has to be a constant process in terms of the monitoring and evaluation, like any other project at the same time. Uh, just a quick comparison around what does SEC US reporting climate disclosure requires versus IFRS versus EU CSRD or ESRS as one of our reporting framework. I think the significant difference between these three, the first two, the US as well as IFRS, they are on a single financial materiality, where the European standards are very much onto the double materiality one. So that's been a organizational impact on the climate and the climate impact on the organization, the financial materiality as well non-financial materiality, both are considered in terms of the European regulation and the reporting standards. In case of IFRS, everything which is financial, which has got a material financial impact, that need to be considered as material and during the materiality assessment, and that will require a certain reporting in terms of metrics and targets. IFRS and the European reporting standard both cover environment, social, and governance, where the US standard is more focused on environment at this stage. And adoption of those regulations, particularly IFRS, has got a flexibility by the jurisdiction that how they want to really adopt it and implement it over the period. So that implementation is different. With in case of Europe and in case of US, it comes down as a one of a directive with a definitive adoption guidelines or a deadline. So just time to act. That's the important message here. Early adoption of IFRS S1 and S2 is definitely going to prepare organizations to understand their own gap and start preparing that talent which they will be needing going forward. Start looking at the technology side. At the same time, will leverage whatever the available support right now. So all the organization, which I'm sure every organization which is a large enough who have got a direct interaction with the large stakeholders, whether you are a listed company, you are a public company, or you have got a business model which have got a direct environmental impact. These are the businesses which are encouraged to start adopt IFRS S1 S2 earlier. We understand from a KSA right now the discussion and debate on IFRS S1 and S2 adoption is going to take place in the first quarter of 2025, and we do anticipate that during the 2025 there will be a certain guideline for adoption, and we also anticipate, like any other country, the first reporting will be done on the financial year ending 2025 or December 25 or early 26. So these going to be the key financial years going forward where the sustainability data required to be reported based on IFRS S1 and S2. So that's all from a presentation perspective, and let's see what kind of questions we have. And also, I'm sure Alina might have a lot of questions at this stage to really expand the conversation.
Thank you very much, Sajid. It was indeed a very comprehensive overview of where we were, where we are going, and what is the way forward to address all the challenges related to it. So that was very insightful. And I think for me, a very big key takeaway was the number of regulations that have come in since 2021 and the pace at which this change is taking place. So, with 173 regulations across the world, I'm sure things are going to move at an even quicker pace going forward. I also have some questions, but I'll start off with the questions that our audience has asked so that we are able to cover everything. So, the first question that we got are that how we see S1 and S2 improving transparency and comparability for the investors. And are there any specific metrics investors are more interested in under these standards?
I think the overall transparency, number one, when you first the recognition the climate risk exists. So I think that's a starting point. There are still a lot of organization or individual who still don't see that risk as a real risk. So I think investors have already mandated most of their portfolio to go green. And if you look at the BlackRock or Vanguard and the large investors who are the universal investors, they have already mandated that they have a plan to go for a net zero emission, not only for themselves, but also for their portfolio. So number one, it basically brings that recognition the climate risk exists. Number two, that give a clear indication or information to investors that how that climate risk and opportunities are being managed and what is material for that particular business. That's how they are really comparing the data from a 1 year to other year, how they are setting the target and bringing the benchmark. So that brings the visibility. The transparency comes through the processes and the oversight which they establish within the organization and assurance which they are getting from a reasonable or limited assurance which they are getting from the third party. So put together all those three things, there is an oversight and a governance process to mitigate it or create an opportunity out of it. Number two, the organization understand the key material areas where they should focus and they have a target to really manage it well. And the assurance and the oversight process in terms of the reporting and the data collection and management, that brings the transparencies and the accountability that whatever is being reported, that's reported in a right way. And the fourth area which brings it out, that for the investor and any stakeholder, it provides the data to compare one organization versus other, or a one sector versus other, or one industry in a one jurisdiction versus the same industry in other jurisdiction. So comparability is something which is important for investment decision, that where they should be putting money and how they are channelize the climate finance or the normal commercial finance in terms of deployment.
Thank you very much. Yes, indeed. I think the whole purpose of having global standards is that the comparability increases not just with your own past performance, but also across industries and across regions also. And with the transparency part, I feel that definitely the concept of double materiality, it's sort of like rather than having a one way reporting, there is a two-way interaction which is being shown. So that two-way performance evaluation is also something which ultimately increases the transparency and highlights the areas which are most tricky for the businesses. So thank you for that. We have one more question which is related to scenario analysis, and it has been requested that can you please elaborate on the scenario analysis and how that is performed?
Scenario analysis has got a methodology that if the organization is working towards that in terms of the implementation, how they are contributing or creating a risk in terms of the meeting the 1.5 degree centigrade increase in temperature or 2 degree centigrade increase in the temperature. So I think that basically helps the organizational contribution towards that overall global scenario. So the direction, actually the scenario helps to really implement that direction and see whatever we are claiming and saying, how it's look like for the future. That's basically an extract of the TCFD. So that's a very well established methodology, and there's a lot of tools available around it, including the Spectrico one, that which can help really use that data and extrapolate that if we meet the target, what does it mean?
Okay. So basically, it's like a combination of the use of the tech part, the existing data, and developing a strategy to identify how our targets can be met.
Exactly.
Okay, thank you. One more question, which is related to IFRS S2, is that how does IFRS S2 address Scope 3 emissions reporting, especially for sectors where value chain emissions are complex and hard to quantify?
I think S3 not only in IFRS S2, it's globally it's right now it's a challenge. So the adoption of the scope 3 as we speak in any jurisdiction that comes with a certain relaxed one. So you can start with the estimate, but the important thing is the identification process, like upstream and downstream processes which have got a material emission. Cracking of that will come with some time. So even in a Europe, when we look at the scope 3 implementation, where the regulations are quite stringent, still they provide a relaxed view around it. Similarly, the IFRS basically talk about the directional, is more directional in terms of the scope 3 rather than a very prescriptive. But value chain risk assessment is a process that need to be there, and the estimates need to start coming out, and then definitely it's going to take some time. When we talk about the quality data which can be assured by the third party, it's going to take its own time. But directionally, IFRS encouraged to start looking at the value chain risk and start collecting data and understanding that value chain risk better, which essentially means we are talking about scope 3.
Great. Thank you so much. And also, I remember you once mentioned this point, and I firmly believe in that, that as the regulations are being adopted in a more broader sense, that more businesses are coming on board, automatically, I think the scope 3 emission calculation will become easier, because what is scope 3 for one business may be scope 1 or 2 for another business. So automatically, when the calculation spreads, this data collection and ultimately its utilization can be easier. And but till that time, yes, definitely the risk assessment throughout the value chain process, that's the main area. So thank you for that. One more question is that how can organizations effectively integrate IFRS S1 and S2 reporting standards into their existing ESG frameworks to enhance transparency and accountability? So the companies with
Yeah.
existing strategy, how can they put that in?
I think if you look at the existing strategy for most of the organization, it's a evolving one. So there is a if we look at that, there is a more learning keep coming out, and the people are improving that. So I think as we speak, and the era which we are going through, the ESG frameworks will evolve, and they will take a certain direction. Whether they take a direction towards the double materiality assessment or a finance emission side, if you're talking a financial institution, or IFRS S1 S2 GRI, or US climate disclosure, which is regulated by SEC, or even the California has got its own regulation, which are more stringent. By the way, California regulations are very strict in terms of scope 3 emissions as well. So that's one of our regulations which are way more stringent as compared to others. So I
Interesting.
think it will evolve, and they have to really incorporate their reporting pattern within that. So in a financial institution where they have already adopted ESRM, so now they are evolving it more towards the integrated framework of ESRM and ESG to make sure they can comply with the central bank requirements in terms of the environment and social risk management while they are financing the project, and at the same time they should be able to report their own sustainability status to the respective stakeholders.
Okay, great. Thank you so much. And also, what are the long term benefits of adopting IFRS S1 and S2 standards, especially for asset management firms? Since we're talking about Saudi also, so I think a very relevant question.
Yeah. So I think first we have to understand how the global business is evolving. So if we look at the global supply chain, the end of the day, whatever business we are in, it directly or indirectly is impacted by the global supply chain, right? So either you are exporting or you are consuming certain products which are being moved from a one place to other place, and particularly jurisdiction. So very recently, if we look at the businesses, there is a certain regulation which are incorporated in US called CBAM, carbon border adjustment mechanism. And the carbon border adjustment mechanism means if we are importing something in the country, or if we are exporting something to EU, so somebody has to really offset the carbon emission which are generated for the production of that specific good or service for that matter. So first understand what happens. Suddenly the global trade require you to report for that particular carton you are sending to us, or that hours of services you have rendered to us, tell us how much emissions you have generated, and there is a responsibility either the importer or exporter has to undertake that they will offset those emissions. So that emissions generated from a one jurisdiction will not become a responsibility or liability of the other jurisdiction. One of the player has to take a responsibility and offset that emission. So that's what's happening in a global trade. So now if you are an asset manager and you have invested in a certain businesses which are unable to really understand their own emission and report their own emission, so that means their significant portion of the global trade will be impacted, or they will not be able to really understand how that business is going to perform, whether they will be restricted or whether they will exist there as well. So understanding the global supply chain now requires the asset managers to really understand what kind of portfolio they are managing and how the risk is being reported. Number one. Number two, again, asset manager comes under the financial institution category, where they have to see how the portfolio is being managed, and wherever they have invested, what kind of emission they are generating. So that's actually for them is a scope 3 emission. And in a financial institution case, scope 3 emissions are very important, just because they are the one who are enabling those emissions for the other businesses. And to really have that finance emission calculated, they need those portfolio companies to report those emissions. So that means those companies have to adopt IFRS S1 and S2, and asset managers have to adopt IFRS S1 S2 to really understand their and report on their financed emission, which are the most critical one, as well as the emissions coming out of from their own operations, because asset managers themselves are also the investee for the investors as well. So there are other investors who are sitting at the back end of the asset manager. They also want to understand how that asset management company is operating. So if you see that there is a complete cycle. So the companies report their emission, that get reported from our asset managers, and those asset manager reported to their investor and the shareholder at the same time. So everybody like to understand the risk management and the significant impact their business can have on a global trade, or the global trade can have a, or CBAM type regulations can have an impact on their business.
Thank you very much for a very comprehensive and elaborate
Alina,
answer. Sorry, can you hear me properly?
yeah, I can, please.
Okay, sorry. So, thank you very much for a very elaborate answer. And definitely, once you talk about international businesses, export, things going beyond borders, then automatically the legislation of one area might ultimately impact the processes, how they are being happened in the other place. And yes, with respect to financing, I think the first controls that are coming are on the financial institutions because they are the drivers behind a lot of businesses. So, putting regulations on them or bringing them into the scope of sustainability reporting is something which will indirectly have the impact on all of their clients also. So thank you very much. I think we've explained it so well, nothing further can be added on this. So I'll move on to quickly to the next question. So how can companies address potential conflicts in disclosures when aligning IFRS S1 with regional standards, such as European Sustainability Reporting Standards or SEC proposals? So, where there is a conflict, what do we do? Or are there any conflicts? First question. And if yes, then what do we do?
Okay, so I think I wouldn't say conflict, but there are differences. So there are similarities and the differences in terms of if we look at the major regulations. So right now there is a regulation from the US side, which is a SEC climate disclosure. Then there is a European side which came up with the regulations as CSRD or SFDR, and underlying reporting standard is the European Sustainability Reporting Standard ESRS, and then there is a global reporting standard which was adopted even way back. That's the GRI. So if you look at the overall reporting standards perspective, what to report and how to really do the materiality assessment, so there could be certain differences in terms of the regulation. And like the world has seen in past in terms of the financial statement, where the organizations are working in US and Europe or a Commonwealth and or a countries which haven't adopted any international standard, they always ended up reporting multiple times. So they have to generate report on US GAAP. Today, the financial reporting, they have to generate report on a IFRS if they have got a, global investors and the US investor. And if they are working in a certain country which requires a certain adoption to the national standard, then they end up doing the same at a national level or at a country level. So they actually create a lot of effort in terms of generating multiple reports to comply with the different regulation or investor needs. But what happened over the period? There are technologies which can collect that data one time and can generate those reports on a different standard. And that's what the essence of Spectrico at the same time. So we collect data as a at a one time, and when we run the materiality assessment, we run in a way to really account for their all potential jurisdiction where they need to report. And once that data is collected and managed, then the report can be generated on a IFRS S1 S2 ESRS or US disclosure, or even going to the California level regulations which they have recently introduced, SP 261 253. And at the same time, the same data is required by the environment protection authorities. They also try to understand how you are managing the species level data in a certain areas, particularly if you are working in a certain sector where the biodiversity and the endangered species are one of a key material topic. So environmental protection authorities will require that data. So the entire mechanism, and that's why the initial strategy and expert consultation is important to avoid that duplication which might come later. So create a framework which is integrated with all the current and the future requirement. So for the next 4 5 years, whatever data is collected, that can be reported on a different standards or for the multiple jurisdiction.
Thank you very much. And I think I was about to ask you the question and you've answered it. So I think thank you to the team which is working behind Spectrico also, because integrating so many different types of frameworks in one place, that's a challenge in its own self. And on a lighter note, I think, Sajid, hats off to you for remembering all the abbreviations as well, because that takes a lot of memory boggling. So with so many jurisdictions, regulations, and the abbreviation, so that's a tricky side. So thank you very much for that. And as we are entering into the last 3-4 minutes of our webinar, there are two main questions which are pending, so I'll quickly ask them. That how do international financial reporting standards influence corporate disclosure of gender diversity metrics, and what implications does this have for investors and stakeholders seeking transparency on diversity, equity, and inclusion?
I think for all the reporting standard, not only for the IFRS, I think all the sustainability or ESG reporting standard have a very specific focus on the diversity. And DEI is one of a key topic once as soon as we enter in a social side. So gender diversity is the one which we normally talk very generally and people report on that. But if you start seeing the reporting as we speak today, you will start seeing the reporting not only on a gender side, but also the age diversity and the background and ethnicity. So these diversity are not only being reported at an organization level, but that's also being reported at a different location level. If the organization is working on a different location, so these standards require a very comprehensive disclosure on DEI. Now, the second part, whether organizations are ready to disclose that. The biggest conflict is that, normally what we see, there is a certain requirement of reporting, and there is a standard require you to report that. But when we look at the data, that data is not really good enough, or it's available but it's not reflecting a pretty picture. So the people choose to first do the transition and then start reporting on that particular domain. But the one thing which I have seen, because there is so much focus on that side right now on D and I, on so that's actually enforcing the organizations to start working on that particular agenda. And I have seen reports which are talking about even the gender diversity at a different level, at a management level, at a board level, at a worker level. And they are also reporting the pay gap at the same time. So how the pay gap is working on the different genders, right? So these things are coming out. So a lot of organizations have started practicing it. And I think that's a very good direction when we see from a social side how the organizations are reporting. And that reporting, not only that, what is the total employee, they also report on that how the new hire or leavers are working. So particularly if you look from a GRI perspective or ESRS perspective, so that goes quite in detail. And I'm sure right now we are talking about S1, S2. There are more standards which are coming out from IFRS, which will be bringing these important topics in a more limelight.
Thank you. And yes, absolutely. When we talk about sustainability, it's not just about the E part. We have to remember that ESG, so not just the environment and governance part, the social part is a very important area. And yes, I've come across certain such reports, and they're very interesting to read because they give you the insight that what the mindset of the company is and how they have a vision of incorporating diversity at every level, which is not just something which needs to come through regulation. It should be a way of doing business also. And one last question that I have in this regard is that how do you feel that the financial reporting is going to change? Once again, should it change? Or if yes, how it should change to have a better reflection on sustainability reporting also, or the way it can support the sustainability reporting?
I think the financial reporting and sustainability reporting will be integrated. The purpose of the both report is to help stakeholder make more informed decisions. So right now, as we see, and it's evolving, the financial reporting and sustainability reporting sometimes are considered as a two separate report. But we are seeing more and more incidents where the within the financial report and US SEC climate disclosure require that to really talk about the financial assumptions and estimate which are result of managing the climate risk and the climate related opportunity within the financial statement rather as a separate one. Similarly, when you are talking about the sustainability reporting, the one of the thing which comes as a part of sustainability reporting is the economic dimension of that sustainability effort. what kind of saving it's generating. Because as soon as you get on an ESG journey, the first thing happens, you start reducing the waste. And we are talking about not the physical waste, but the energy waste and the productivity waste, motivated employees you get in a better way, governance which reduce the risk as well as the cost of managing business. So all those things start reflecting somewhere in the bottom line. And how to really associate and attribute it with the sustainability or ESG metrics. So that's an important component. So I think I see a lot of integration coming out from a financial and sustainability reporting. So as long as the standards are requiring as two separate reports, but a lot of information will be used from a financial report in a ESG report and from ESG report to the financial report. But ultimately, what we are seeing, the stakeholders are the same, particularly from an investor perspective. It's the one stakeholder who would like to see the financial performance and the ESG performance while they are making their decision.
Done. Thank you so much. And with this, we come to the end of today's session. This discussion is ongoing, and with an expert like you, there are lots of questions that are still pending. So I hope our audience can also reach out to you if they have any questions later on. And also for the audience, please keep in mind that there is one more pre-COP webinar that is coming up on 7th of November. So please stay tuned for it. And if you have any questions related to double materiality and the European side of the work also that's happening, please join us for that. Thank you so much, Sajid, for taking out time today and sharing this breadth of information. And we hope to keep on learning from you in the future also. And thank you to the audience also for joining us today. Thank you.
Now, thank you, Alina. Thank you for being such a wonderful